Hi, everybody. This is David Skarica. What I'm going to do today is we're going to look at interest rates again because they hit a new high in yield. Um, so, um, there's a few things with this. We're going to look at, and actually, I'm sorry, I'm just going to talk here for a second. So, I want to get a chart that a friend of mine, one of my subscribers, longtime friend, Michael in Ridgewood. I won't give away his last name. Sent me, and it was the percentage of bonds that is owned by foreign investors. And it's pretty interesting. I just got it up here on Twitter. Luke Roman, who does some excellent work, I wrote it. So and we'll see this here. So that and we're going to show this as well on top of just the yields themselves. So, because we had a new high again today in the yield, and look, inflation probably is still topped for the short to intermediate term, but we're seeing these higher yields. You have to wonder why. Part of the reason is, okay, the Fed is, not going to be quite as aggressive as, not going to be quite as aggressive in terms of cutting rates as people thought. So that's coming out of the bond market, et cetera, et cetera. So this is kind of this right now. And but there's other reasons, and we're going to show you here. So let's just actually show you the rates themselves. So this is the 10-year bond. And I drew this line because we hit 490 today. First time we might hit 5% since 2007. So again, with the highest since 2007 for a 16-year high, right? And then if we were to go above, 5.25, 5.5, again, that would be the highest since like 01, 02. And then if we were to go to 6%, I don't know if we're going to get that high in this phase of the cycle. That would be highest since the 2000 .com bubble. And of course, the debts in terms of individuals, corporations, governments are a lot higher now than they were in 2000. I think the government debt to GDP in 2000 was like 40%. Now it's 120%. So then if we look at short-term rates, they're even worse. This is the IRX. And again, this is the highest since 2000. much, much, much worse. So again, that's the kind of thing we're seeing here and the whatnot. So these are a couple of these things too. So that of course affects the affordability of housing, and because housing prices are still expensive and rates are way higher. It now takes $115,000 to afford a median home U.S. house. And remember, that's not like in places like New York City or L.A. or San Francisco where prices are sky high, or Miami. This is all around the country. So places like Wichita, Kansas will be pretty cheap, but places like I just mentioned would be very expensive. So you need to make that, and you can see back 10 years ago, you need just above 40,000. So, and again, I equate it again to my house here in the Bahamas that the same thing has happened where, I would basically need twice the down payment and I'd be paying almost twice the interest rate of what I paid then. So this house would almost be unaffordable, So that's interesting. So we'll go back. And then again, the TLT, like we just showed you, now closed at the lowest price since 2007. Like I just showed you, the interest rates are also at the highest since 2007. Et cetera, et cetera. So again, this is at a time, and the housing prices haven't come off that much. So, and then a lot of people have way more debt. So I don't understand why this is not hitting the market more. It shocks me because the consumer is just going to be decimated here. But, what are the old saying? Markets can remain irrational longer than you can remain solvent. So these things, in my opinion, are all headwinds for markets here, going forward. So again, and like I've shown in the past too, again, I talked about KBH yesterday, so we'll look at that again. And you can see like KBH is almost at its all-time highs, and that's despite the fact, where rates are where they now are. So anyhow, but you can see it was off almost 3% today. So it's finally looking to me like it just closed under the 200-day. So maybe it breaks that and moves lower, kind of like it in early 2021. And KBH had quite a decline there. Went from about 45 to 25. That was a 44% decline. So will we see that again? I don't know. But again, the theme of this again is these high interest rates. And again, this is to show what what I'm saying. So what's driving this? So this is really interesting. Here you can see the foreign holdings of treasuries have gone up, but when you take it as percentage, because so much debt has been issued, it's collapsed. Like the foreign holdings of TIPS and other debt instruments have gone from over 60% of total U.S. debt in 2008 to 33% now. Treasury bills, which you can see above here, the percentage has gone from 50% to 23%, and you can see nominally it's gone from 5 trillion to 4 trillion. So like we're seeing foreigners, and I think I've said this over and over again. I think the Russian war was a big part of this. Like I think that once you weaponize the dollars, a lot of countries around the world don't care about the Russian war the way the U.S. or the West care about it. And they were like, well, you're never going to do that to us. You're not going to control, our currency or the amount of debt that, we own in your dollars and make it unaccessible, if we have a regional conflict, which is really what Ukraine, Russia is. I know maybe some of you are very pro-Ukraine or pro-Russia. I don't know, but I see it as a regional conflict. And I think the action against it was draconian. And I think it really kind of set in motion this kind of really big decrease. And look at the U.S. right now, debt is 8%. Our deficit is 8% of GDP. It will probably go to 10 to 15% in the next recession. Who's going to buy this stuff? I saw some silly article saying, "Oh, retail investors will now make up for this lack." Total BS. No, you need these big foreign central banks, foreign institutions buying this stuff, and there's too much of it now. It's like classic, supply demand, capitalist economics. So too much stuff owns it, too much supply, not enough demand means higher pressure on rates. That's the real reason rates are going higher. It's actually not even because of inflation and etc. Right? And now now they're going to be funding the war in the Middle East on top of Ukraine. And who knows what happens if something happens with China and Taiwan? You're going to fund that war too when your debt is 120% of GDP. So again, more debt, I think it increases the amount of debt outstanding. Foreigners are not picking up the slack, and rates continue to go higher. And of course, the Fed right now, because again, the problem with the Middle East conflict is, we'll go to shorter term. This is the oil ETF. It of course puts upward prices on oil. You can see oil is up 1% today. We're getting back to the highs of like August, September here. So, that's the problem too, is that a Middle East conflict is always kind of inflationary because so much, resources, especially oil and gas, is produced there. So I'm going to leave on that stock chart of the day today. We're showing again another surge, another multi-decade high in interest rates, and what does that mean longer term? Tomorrow we're going to look at a stock that's starting to show signs of rolling over. One of the big, stocks everybody loves. That will be our stock chart of the day for Thursday. So again, tomorrow I should get back on track where I do these things like earlier in the morning. Sorry, I've just been taking care of a few things here the last few days, but I hope you enjoyed them. It doesn't seem to have affected the views on the charts, which I'm happy about. So tomorrow I'll look for a stock chart of the day more earlier or midday.